In this video, I want to consider the power of central banks. The power of central banks, in other words, we talk about, stock market response to political development. Every country in the world and has central bank. In the US, it is called the Federal Reserve or whatever. In Nigeria, it is called the Central Bank of Nigeria. They call it the Fed in the US. I think Federal Reserve also. In Nigeria, it is called the Central Bank of Nigeria. So central bank policies significantly influence the stock market sentiment during political changes. So here are some, in this, I want to talk about kind of key, concise and breakdown of this particular subject matter. Number one here is interest rate adjustments. The central bank is known to adjust interest rates to battle or to mitigate, the effect of inflation in the economy. So in this case, what is called rate cuts, rate cuts. And lowering rates can boost market sentiment by reducing borrowing costs and stimulating investment. Usually, the rate of borrowing and even the amount people borrow is controlled essentially by the interest rate. The lower the interest rate, the more people and organizations and even companies borrow. The more they borrow, the more it stimulates the economy. The more it encourages spending. All right, and so the more people spend, the more companies tend to make profits. In the case where there's rate hikes, there's that increase in rates. Increasing rates may dampen sentiment by raising borrowing costs and potentially slowing economic growth. Whenever there's an increase in borrowing costs, people tend to borrow less or not even borrow at all. As if they don't borrow, they don't spend. If you don't spend, discover that companies will no longer have the level of profitability they used to have, and the lower company earnings and profitability, essentially, that would affect the economy, negatively. Number two is quantitative easing. Quantitative easing. It is called QE. This involves injecting liquidity into the economy, and this can also, reassure investors and support, stock prices, especially during political instability. It happened during the COVID-19 crisis, pandemic. The U.S. government, kind of gave out cash money to the citizens, and that, encouraged spending. They had QE1, QE2, I think QE3 or so, something of that nature. So quantitative easing. And even my own country, Nigeria, something of that nature equally took place. The government kind of, gave an amount of money to families, to households, to cushion the impact of the pandemic. There is unwinding QE, unwinding, quantitative easing. Reducing liquidity can increase market uncertainty and lower stock prices. In this case, there's a kind of reduction in liquidity when the government tries to slow down on the rate at which it provides money to households. So in that case, discover that it will introduce uncertainty, and that would not augur well with the market. Please like this video and subscribe to this channel if you've not done that. Number three is forward guidance. Forward guidance. There is this clear communication from central banks, and it's aimed at stabilizing the markets by providing certainty. Ambiguous signals can lead to volatility. Even when the central bank isn't really carrying out a kind of, probably physical procedure to adjust, factors in the economy, even the utterance of the central bank governor could have a tremendous impact in the economy itself. As the people pay attention to utterances and statements, issued by the central bank, the governor of the central bank, and so it provides a kind of guidance as regards to where the economy is going to, as regards to what the central bank is doing to put the economy in good shape. And not only that, there's number four is inflation control. Inflation control. And so in this case, if political changes leads to inflation concern, central bank may adjust policies to control inflation. And by so doing, it tends to, boost or, it boosts, consumer sentiments if the policy concern is effective. That is it. So it has that particular tendency of, controlling their actions can control, consumer sentiments. If actually it is done in an effective way. And so once sentiments are positively handled, you discover that inflation could be met to, it could somehow mitigate inflation. Number five is currency policies. Currency policy. Central banks intervention. They tend to the intervention is aimed at stabilizing currencies and during political changes, and it can reduce volatility and improve market sentiment. So the central bank aims to stabilize the currency of the country, particularly during periods of political changes. And so this particular action will go a long way in reducing volatility in the markets and could as well improve positive sentiments, by investors. You just know, whether you like it or not, the market is controlled by sentiments. Apart from reason, logic, and hardcore facts, sentiment plays a key role, in market fluctuation and market behavior, participants' behavior in the markets. Number six is banking sector stability. Banking sector stability. Central bank may act as lenders of last resort. That's their primary assignment also, ensuring financial systems and stability, which can support positive market sentiments. They are lenders of last resort. In other words, they lend money to commercial banks. They lend money to financial institutions, in the economy. And the more they lend, particularly at a lower interest rate, the more it will affect the economy, positively and significantly as well. But if they lend at higher interest rates, then of course it's going to affect the economy, somewhat, negatively, and it might equally, tend to reduce inflation as the case may be. Depending on how you look at it, it could reduce or lower inflation. Number seven is a global spillover. Global spillover. Central banks' actions can have a global impact, particularly, in the case of the Federal Reserve in the U.S. Whenever they undertake certain policies, it might even affect the entire, to have a global impact. So influencing stock markets worldwide, depending on whether policies are seen as stabilizing or risky. And so central bank policies, particularly for developed countries, can have an overall impact in the world economy. So overall, central bank responses to political changes can either calm markets or increase uncertainty, depending on their effectiveness and clarity. These two factors are very important. How clear are these policies and how effective are they? If they're effective, of course, it will go a long way in accomplishing the goals it's intended to accomplish, which is what to be able to make, to stabilize the currency, stabilize the economy in times of political uncertainty.